Let's start uh, because we are waited for a little while. Okay. Uh, Foreign exchange transaction. I think there are a couple of sessions I need to take. Today I will be taking only 2.5 hours. Uh, there are 8 hour sessions generally I used to take. So 4 hour session too because I apparently have seminars today for 1 o'clock. So I stopped at 11 o'clock today. We will carry out 2.5, probably other 2.5, probably let's see how best we could continue maybe 3 hours or 4 hours last session. So we will have it at least three sessions to cover this particular whatever the segment given to me. So let's start. What is foreign exchange transaction? So you know this is the talk of the town in Sri Lanka. We really look at it. Foreign reserves. Everybody talks reserves. So there we are looking into foreign exchange transaction. Why foreign exchange transaction? What do you understand by foreign exchange transaction? Because you know, if you take countries, every countries do not have uh, all the resources to produce the goods and services a particular country wants it. It's not possible at all. We are in the developed and we are into high technology used countries. Most probably, most of the countries are. So there is no country can in isolation to remain there and say we are not communicating or we are not contacting any other rest of the country. We can on our own we can survive. No country in the world could do this unless you have been sanctioned by the regulatory authority, international regulatory authority. You can't deal with any country. So those countries we can see poverty prevail. You take North Korea and Syria. These are Sudan. These are the countries sanctioned. So they have been isolated. But there again, when you have a sanction, those countries have been permitted to get down essential good like medicals, all those essential. But that itself giving us an indication how the international trade is so important. Uh, it is because you need to have a wider market. The country which has produces a certain commodity, if the commodity is specialized and they have excess unit, they have to go out of the country to sell those stuff. So it's a market expansion. If you talk about international trade, it's all about the market expand. You expand your market, right? And in the same time, there are commodities which you are unable to produce locally, or you may produce it will be at a higher cost. So the comparatively, it's better that you get down from other country at a cheaper cost so that the domestic consumption could be maintained at a manageable level. So that is the reason every country is getting into foreign exchange transaction. So in other words, simple word, you call it as a cross-border transaction. You are crossing your border. So geographically, every country has a border. So if you have a border, what happens? You are crossing the border. That means you are trying to deal with another country. So that is what all about foreign exchange transaction. You are doing a transaction with other counterparty in other country. Then you need to be aware of, okay, if you are doing a foreign exchange transaction, we need to have some reserves, some foreign reserve for us to do this transaction. So you can't be dealing with your local currency because your local currency is not accepted in rest of the world. If you take Sri Lanka rupee only can be used within our geographical area. Within our demarcation of whatever territory we are in, we can use the LKR. That is a legal tender in Sri Lanka. But you can't use the LKR in India or a neighbor country, or you can't go to any other country and use LKR. But if you take some other countries, currencies like US dollar, most powerful currency in the world, US dollar. Why is that more powerful currency in the world? Why everybody prefer to keep reserve as dollar? Because the economy is stable. It is one of the biggest economy running up to 22 to 23 trillion economy. So when you say trillion, you know, 1,000 billion is 1 trillion, right? So that's about if you really look at it, that's about 22,600 or 600 plus $1 billion economy. By the way, anybody can tell me what is the economy size of Sri Lanka? Anybody? What is roughly economy size of Sri Lanka? How many billion dollars? Yeah, anybody knows what is the size of Sri Lanka economy size? GDP is about $82 billion. 82 billion, right? Remember, we are talking about $82 billion, right? Countries like developed countries like other countries are trillion-dollar economy. About 10 to 15 countries are there trillion. So that means they are 1,000 billion. So we are just 85, 81 to $82 billion economy. So you can just see how small, tiny dot we are when you compare with the rest of the world. So still, we need to involve with the international trade. We can't in isolation. We are a smaller country. We don't have all the resources that we can produce all the goods and services that we can consume. So we solely depending on foreign trade. So you need to have foreign reserve for you to do the transaction. So when you do a lot of export, then you build up your foreign reserves. So the foreign reserve means you keep save foreign currency. Everybody prefer to have reserve as US dollar because US dollar is considered as one of the strongest currency because the economy is doing well. So the stability of US dollar could be interpreted in different manner. But can I know, by the way, what is the highest denomination of dollar notes? Now, Sri Lanka, if you take it, you have a 20 rupees note, 50 rupees note, 100, 500, 1000. Then we have 5,000. There's 2,000 was there, but with hardly in circulation, you have 5,000 notes. So we have up to 5,000 rupee notes. If you take US dollar, what is the highest denomination? Can anybody just tell whatever you know? Just contribute. No mind, just try some figure. What is the highest denomination you think US dollar? It's 100. It's still 100. So that speaks volume about the stability of the currency. Still 100. 100 is the highest denomination of US dollar. So that shows the stability of the currency. So that is the reason everybody prefer to have US dollar as a foreign reserve for them to do the foreign transaction. So yeah, I'll just give you example. Sri Lanka, we do not have oil, right? So there are trade take place because of simply if you don't have a particular commodity, you need to go to the international market to buy. But otherwise, your people are unable to consume. The domestic markets is bonds of a particular commodity. If you take Sri Lanka, we don't have crude oil. That's the biggest problem, right? We don't have a crude oil. Most of the country do not have. Their import is only depending on they are running on vehicles or crude oil. So oil we don't have. That is the biggest expenditure. One of the biggest expenditure commodity what we import is the crude oil. Then comes to gas and all, right? So this crude oil, we are unable to produce. That means we don't have any resources to produce. Likewise, most of the countries can't produce. But we have our expertise of we will consume. We have more than our consumption. Maybe we will have a tea. So our extra commodity could be tea. So what we try to do that when we want to import oil, we don't have foreign reserve. But where do we collect our foreign reserve? So we have our excess commodity, or maybe we are specialized in certain commodity like garments, tea. These are commodities we have been traditionally the crops, biggest crops like tea, rubber, coconut. These are our major export commodity, staple income for some time. Now the things have been changing, but tea also we are slightly loose in the market due to higher competition. Our cost of production is increasing. We will be unable to keep our rupee stability remain stable. So due to that, the cost escalation has gone up. So therefore, we are not a very competitive in the world market. So there we are slightly very fragile. If you take tea commodity, tea prices going up, tea prices coming down, but somehow or other we still export tea fairly large extent. So we solely depending on these commodity exports, right? So whatever amount we collected, we need to pay for import. So a country which has a commodity which could be specialized can be exported. If you take a Middle Eastern country, they have enough money because so they are so rich. If you take Dubai and all, you'd have seen that how the Dubai has been developed due to this World Cup matches. You'd have seen that how that country have been developed, right? So everywhere you can see because they have flushed with lot of resources like crude oil. Uh, those are limited resources. They are selling it to the market and buy whatever the commodity they want, right? So So international trading simply involve goods and supply goods and services. Yeah, supply of goods and services. It is not only merchandise; it is also invisible uh, services that you offer also contribute, right? So if you take Sri Lanka, yeah, our services also fairly larger quantum. Tourism also comes as a services and foreign expatriate workers working and bring the remittances. Those are fairly larger contribution to the foreign exchange inflow to the country, right? So how do you differentiate a domestic trade and a foreign trade? Yeah, when the goods are traded uh, between a buyer and seller within a limited market, within your territory, you call it as a domestic. But when you are trying to trade with different country, obviously you will be doing transaction with other country. You need to convert your own currency into other currency. That is all about foreign trade. So the moment you try to import or export goods or services with other country, then it's becoming international trade. That is how the domestic trade differ from an international trade. So within a country, you don't have any problem. So we buy whatever the goods and services, we pay our legal tender, which is rupees and cents, right? But if you try to do with the transaction with the other country, you need to have reserves. So that is called foreign reserve is really required. So you how do you convert as a person if you are an importer, you have only LKR because uh, we don't circulate dollar as our legal tender is a rupee. So everybody importer export they will have only rupee for the expenses, they need to have a rupee. But they need to convert the rupee into foreign currency. There only the problem comes. That is what the foreign reserve all about. Because you, sorry, you can't do your trade transaction in LKR. You need to do foreign currency. So then you need to convert your own currency into foreign currency. That is what conversion. Then there is exchange rate involved. So you know when you are working in a bank, there are two type of exchange rates involved. You will one side you call buying exchange rate and selling exchange rate. So you what is exchange rate in simple? In terms of your currency, in terms of you quote in a foreign currency. For example, for $1 to be buy, we need to spend 205 rupees or 10 rupees, the official dollar rate. So you need to spend 210 rupees of your currency to buy $1. Or if you are getting $1, you will be getting rupee equivalent of 210 rupees. That is the exchange rate between US dollar and Sri Lanka rupee. So exchange rates are used in international trade. So you need to go to a particular bank. Uh, you need to go to a particular bank uh, to convert your own currency into foreign currency, or if you're getting foreign currency into LKR. That is where somebody has to be nominated to do this. Who is that somebody? That is what you call authorized dealer. AD, authorized dealer. So authorized dealers are entrusted by central bank. So central bank as a monetary board, they give a license to all the commercial bank as authorized dealer. So definitely all the commercial banks are authorized dealer. So commercial banks are fully fledged authorized dealer. What do you mean by fully fledged? Yeah, they can do everything. They can buy, they can sell, they can lend, they can borrow foreign currencies. That he means fully fledged. Can somebody tell me, uh, is there any other segment in the market with not a fully fledged but have a restricted power? Can anybody? Example, they also can do one or two transaction but restricted. Who are those people? How do you call them? Feel free to talk. Right or wrong? You can hear me, right? You need to support me because I don't know whether you all are hearing. You can hear me, right? Can you hear me? Somebody say yes.
Yes, sir.
Ah, yes. Okay. I know that you are hearing. Fine. I because in virtual class, The presenter do not know what is happening on the other side. So that is the reason I'm keep on saying whether you all are there. I don't know, right? I'm unable to see you. So sorry for that. Because right, okay. Authorized dealers permitted to buy, sell, borrow foreign currency. Okay, but the question what I ask is, commercial banks are fully fledged. That means they can do every foreign exchange transaction. They can buy, they can sell, they can borrow, they can lend, everything they can do. But what I ask is whether is there any other person who can carry out certain foreign exchange, not a fully fledged. Fully fledged means everything. You are fully fledged means you can do everything in foreign exchange transaction. So commercial banks are fully fledged. But my question is there any other body who is doing foreign exchange transaction not fully fledged, just as a limited? Example, yeah, money changer. Yes, money changers are there. They also can exchange your money. They can't issue, but some of the money changers are permitted issue. Only they can deal in foreign currency, buying or selling. That is money change. So they are limited power. They are restricted dealer. So they are not fully fledged dealer. They are restricted dealer. So those are money changer. You would have seen some money changer, right? These days, these people are highly connected and spoken because the shortage of foreign reserves. Right. So AD stands for authorized dealer, is permitted to buy, sell, because they can buy and sell and lend and borrow. Everything they can do. That is what you call them as. So who are those fully fledged? All the commercial banks are fully fledged dealer. Yeah, whenever you do transaction as authorized dealer, you are supposed to exercise due diligence to ensure the bona fide transaction. So I have put it in red, due diligence. What do you understand by due diligence? When you do transaction, you are expected to exercise due diligence. Remember, when you are doing foreign exchange transaction in Sri Lanka, there is something called Foreign Exchange Act. Earlier, it was Exchange Control Act that has been in existence in more than 63 years. In 2017, that was replaced by Foreign Exchange Act. So we have been using Exchange Control Act, which has been in existence for more than 6 decades, had been totally removed and replaced by Foreign Exchange Act. So you know there is a Foreign Exchange Act enacted that is in force. That act will issue directions to the authorized dealer how the foreign exchange transaction should be carried out. What are the documents you are supposed to take in? There are certain transactions permitted. There are certain transactions not mentioned or you are unable to do it. So you know there are a lot of direction, sort of circulars. You internally you call it as within your bank you call it as a circular, but when it comes to the regulator, central bank point of view, they will issue direction. So that direction will be circulated among your within your bank as in the form of a circular. So then you know when you read the circular, you know there are a lot of restrictions. There are a lot of things that bank has to do. That exercise is called due diligence. So when somebody comes to your bank to do a foreign exchange transaction, you can't simply accept everything and do. No. There are direction, there are guidelines, there are internal policy of your bank. All this you have to take into put into here before you issue or before you say yes to the transaction. That exercise is called due diligence. In other words, simply due diligence means you do a thorough examination, verifying the document. You do a lot of activity. You collect documents, verify the document, and then you make a conclusion whether this particular documentary evidence supporting the permitted transaction, whether you are happy or you want some more documents from the customer. That entire exercise is called due diligence. That's what I put it in red. It is very, very important. Before you say a transaction yes or no, you have to exercise due diligence. Then you are learning a word called bona fide transaction. That means it's a genuine transaction. Bona fide is a genuine. Opposite is mala fide. Mala fide is not a genuine, illegal transaction. Bona fide is a genuine transaction. So it is a genuine transaction. It is a authorized transaction. So you need to make sure whether the transaction is permitted by the regulator's direction. Then if so, what is the exercise you have to take in care? What are the documents you are supposed to take in to verify whether this particular transaction falls, meets the requirement under the direction as an authorized transaction? If I give you an example, if somebody comes to your bank, you are working in the foreign counter, somebody comes in with a passport and a written air ticket and comes and asks you, I'm going to India, I want some foreign exchange. So you need to know whether this particular type of transaction is permitted, first of all. If it is permitted, what are the documents you are supposed to take it? The entire process is called due diligence, because you are ensuring whether this guy is going to the particular country, whether he got a visa, whether he is going back and coming back. All that you are looking into by the documentary evidence. That is what you call due diligence. Why due diligence is important? Because you want to ensure that the transaction is genuine. That is the reason. So it doesn't matter. It doesn't mean that just because of central bank has given you title as authorized dealer, you can do all the foreign exchange transactions. Simply no. You need to be exercise cautious, because as an authorized dealer you are to exercise due diligence or tight steps to be taken to ensure the transaction is genuine, simply because we don't have foreign reserve. They're short of foreign reserve. So these transactions, you are remitting money outside. So there will be a lot of restriction. When I say restriction, permitted transaction could be carried out. Lot of requirement. More than the restriction, the appropriate word should be lot of requirement. Documentary requirement. It has to be permitted transaction. Supportive document should be given. So if you have any element of doubt, you simply say, no, we can't do that to the customer. You turn down the customer, and you should be have a valid reason to turn down a request, right? So you know what is so exchange rate. Yeah, that is where the exchange rate is involved. When you do the foreign transaction, definitely exchange rate will involve, because you are not doing transaction anything in your own currency. You are trying to do a transaction with the other counterparty. So other counterparty do not accept LKR. You need to convert. So generally everybody try to deal in foreign exchange transaction in US dollar, simply because that is a reserve currency. Everybody try to keep reserve currency as reserve currency, mean keeping foreign currency in a domestic country we call reserve currency. So our reserve currency is not only ours, majority of the country using reserve currency as US dollar, because that is a stable, robust currency, because the economy is stable. Right. Okay. So you know why dollars are used. So we need to convert rupee into LKR or LKR into rupee. You call exchange rate, right? So authorized dealer play a key role in doing this foreign exchange transaction. Right. Now we are coming back to, okay, if you are permitted to do as authorized dealer, then you should know, okay, you have been permitted to do a lot of transaction as authorized dealer. Then how you are going to do a transaction with a counterparty in Japan? So there should be some way of communicating to, you are getting the assistant of a bank in Japan for you to do a transaction with a Japanese client. Say your customer is importing some vehicle from Japan. Now, currently you can't do that. It is restricted item. I'm just giving you an example, right? If you are importing a vehicle from Japan, so the local importer has to deal with the supplier in Japan. So he says, I want to get on a vehicle. I want to open some transaction. I want to carry out foreign exchange transaction with a party in Japan. So he comes to your bank because you are an authorized dealer. So as an authorized dealer, you can't carry out this transaction without having a proper correspondent banking network. So what do you mean by correspondent banking network? That means you are having a relationship with a bank in other country. It's called correspondent banking relationship. You need to have a correspondent banking relationship. Simply remember, correspondent without correspondent banking relationship, simply you can't do any foreign exchange transaction. You really require a relationship with other bank, right? That is the reason you would have seen most of your, when you go to your bank, foreign department or trade department, you can see they have lot of dealing with lot of foreign banks. Those messages are coming through Swift. Swift is the mode of communication used to exchange messages between uh, foreign banks. So you call it as correspondent banking. So initial step, you need to have a relationship with other countries, because without that relationship, you won't be able to do international transaction. You don't be able to do transaction with rest of the global country. So you have to have a relationship. How this relationship will be established? simply because you need to have a correspondent banking. It is very very difficult to establish a relationship with a developed country by a developing country. Let's say we as a Sri Lanka developing nation, so we want to have a relationship with a bank in Australia. So the bank Australia is a developed country. They are with a high tightened regime, a $1 trillion economy, bigger country, right? So it's a bigger nation. So how they will treat us? They will treat us as small countries like Malay, Bangladesh, Nepal. We are into that size economy. So and they look at our economy size. They look at our GDP. They look at our bank's balance sheet size. Everything matters for them because if they feel this particular region is riskier region, they will not say simply no, we can't have a relationship with it. So I will give you an example. If a bank in Afghanistan or if a bank in let's say Syria coming to you to open a relationship, you might turn down because Syria is a sanctioned country, Afghanistan is a risky country, high risk country. So you don't deal with those countries. You know, if you take the recent development is a Lebanon. So Lebanon also got into problem now. Just the same problem what we are facing, they have gone through, and that country is now almost bankrupt. Now they're slowly, they are gradually getting back. You know, you would have seen most of the Sri Lankans who are working in Lebanon have come back to our country because the country debt is gone more than the assets. That means when you say a country bankrupt, what do you mean by bankrupt? So you need to pay outsiders more than your reserves. Then you are a bankrupt person. You are an insolvent person. What does it mean to you? So you take your personal life. You have borrowed 1 million from outside. Whatever asset you sell it, you can't even select 5 lakhs. So you are a bankrupt person because you are owing outsiders more than what you have. That is you call bankrupt. The country has gone down. They are into minus. The asset is into minus. That is called bankrupt. So they look at when you want to establish a relationship with a correspondent bank, they look into everything. So that is the reason it's become very very difficult. If you really look at it, banks to do corresponding relations. Those days, countries are okay, stable. Though we are developing country, we are not into any of those lists. International credit ratings are fairly okay. We were B. Now we got into C. Now lower grade in our international credit ratings also gone down. So we are in a very bad position now. So opening correspondent at this moment going to be a tough task. But we have already opened, right? When we were very good, we opened relationship, right? So correspondent banking, I'm just doing my presentation based on our economy. So this theory you will need to apply to, you need to apply. This is international subject you are learning, but you need to apply to the context of our country. What are we doing? Then only you will have a better understanding, right? So correspondent meaning our bank has to maintain relationship with other bank. Yes, we have maintaining. If you take Bank of Ceylon, they are having a relationship with a lot of bank in Australia, like other bigger banks having relationship. It is the current situation, so you can't take it as a current situation uh, as a subject context. This situation can be resolved within 1 or 2 years, hopefully. Then we back to our normal. We will our credit rate will improve if we are into go right track. Definitely we can. So open trade we will go through this tough period, maybe 1 or 2 years. Then we are okay. Hopefully we are get back to the right track. Then everything will fall in right place, right? So so a relationship means you are establishing a relationship with other bank. So when the other bank taking you to relationship, they will look into so many issues. That is what I explained to you. A country situation, what is their standing, whether the country is internationally accepted standard of practice, right? There are so many international good practices. Are we practicing? If the country is practicing, they will accommodate. So likewise, every bank try to have a correspondent relationship within other countries with other banks. Then only they can do foreign transaction. That relationship is called foreign correspondent banking relationship, or you may call it as a correspondent banking relationship. So remember, in Sri Lanka, if you take all the banks having relationships. If you take Bank of Ceylon, they might have about 10 to 15 bank relationship in Australia, maybe 2 banks in New Zealand, maybe other 10 banks in USA, maybe other 5 banks in UK. Likewise, Bank of Ceylon, People's Bank, Commercial, HNB, some all these bigger banks will have a global presence. That means they have their correspondent relationship with many of those countries. Right. Now, that is very important, right? For you to communicate, there is something called a communication method. That method or mode is called Swift. So Swift is what is anybody can tell me what is Swift stand for? SWIFT stand for, right? So if you are not heard about it, you won't be able to tell this. Swift is a mode of communication. Swift stand for Society for Worldwide Interbank Financial Telecommunication. This is actually a kind of a company, a society, initially started up uh, in Belgium, it was in Brussels, right? So this particular Swift is kind of a small organization when it begins its journey. Now, more than 220 countries have joined. It's become the communication tool globally. So once you become a member in this group, Swift group, you will be given a big code. You will be given a Swift code. So with that Swift code, you can communicate. So every banks in Sri Lanka, if you take 220 countries, most of the countries included, everybody using a Swift as a communication tool now, right? So the moment you become a Swift member, you will be given a particular code. So if you are working if you are working in Bank of Ceylon or People's Bank, you will have a one unique code for Bank of Ceylon, one Swift code for Sampath Bank, one Swift code for HN. So likewise, every bank will have a unique Swift code once they become a member of the Swift. So this is the communication mode used to exchange messages between bank to bank overseas, right? So this is the mode Swift. So the Swift will be having generally it is letter, but there are last few digits number. So you can consider as a alphanumeric. So this Swift is minimum you should have 8 characters. Minimum 8 characters can go up to 11 characters. Minimum 8 to 11 characters the Swift code is, right? So uh, so if you want to communicate with the other bank in other country, you should have Swift. You should be a member of the Swift because everybody is now a member of the Swift. Then once they member, they will be given a code. That code is called BIC code. BIC stand for Bank Identifier Code. So you will be given a big code. So you can call it as what is your. Somebody might ask you if you are working in a bank, what is your Swift code? So you should know your Swift code of your bank, right? So the generally Swift code four letters, first four letters. So if I tell you HBLI is at National Bank, first four letters, HBLI. Then the fifth and sixth character, remember, that is the common character of the country. So every country, as per the ISO standard, are identified with two letters. Sri Lanka identified as LK, USA identified as UK, UK identified as GB, India identified as IN, Australia AU. Likewise, every country globally, they have a country code, two-letter word, two-letter, English two-letter. So what happened when you have a Swift code in Sri Lanka? If you have a Swift code, your bank name will be there as four-letter. Fifth and sixth will be LK. Then the seventh and eighth, you can use it either you to your branch network or you simply say XX, double X or whatever. Or in Sri Lanka, if you look at all the banks in Sri Lanka, everybody will have, if I take HNB, HBLI, LKLX. So like the Bank of Ceylon Mays, they have Swift code maybe BACY, LKLX. So the LK is a common for every bank in Sri Lanka, fifth and sixth. First four letter, depending on the bank's name, it changes, right? So a valid Swift code should have at least 8 characters, right? So that is how the Swift code. So once you become a Swift code, you will be given a big code. With that, you can start exchanging messages with other countries, the banks in other countries, right? So this relationship, when you want to establish a relationship one bank with other bank, you generally call that as RMA. The request is considered as you are requesting a relationship management application. Through the SWIFT system, you are making a request. The request is considered as RMA. How do you call that? RMA stand for Relationship Management Application. That means through the SWIFT, you are making a request that you want to establish a relationship. Let's say Bank A in Sri Lanka making a request to Bank B in Australia to establish a relationship. So the Bank A making a RMA request, a Bank B to communicate, and they want to send some messages. So the Bank B look at Sri Lanka banks. As I told you earlier, they will look at all the aspects, because what happened in current context, establishing a corresponding relationship is lot of expensive affair. Why do I say every bank is, why they are very particular to, because the once you establish a relationship, remember, you have committed to accept their messages, send your messages to them, receive their messages, then they have become one of your correspondent bank. But if your correspondent bank, let's say, get caught to some wrong activity, they have violated something, then you will also get affected, because you have a relationship with that particular problematic bank. That is the reason everybody is scared. If a country is vulnerable, if the countries do not have their internal policies straight, they have lack in their governance, the banks are not very stable. So in an economy like that, you will tend to think very high to establish a relationship. So if the internal management of the governance of the country is very weak, you tend to reject the relationship. So if I give you an example, if Afghanistan bank comes and asking us to establish a relationship, we simply say no. We don't deal with any bank in Afghanistan. We treat that country as high risk country. There's no governance, there's nothing taking place, it's high risk. So we will simply say no. So likewise, when we make a request, the other recipient bank might accept it, because Sri Lanka is okay, Sri Lanka is stable. So that is how they accept it. So each bank will accept the request whether to open their communication door to somebody send the messages. You have to accept the RMA request. So once you accept the RMA request, both bank can send messages each others. So once the RMA says, that is what when you are talking to foreign department people, they will say, when you want to open LC or whatever, they will first ask, do we have a RMA with a particular bank? RMA means whether we have a relationship. So if that relationship is there, you are simply having a correspondent relationship. So you need to have a correspondent relationship with deal with other bank. If you don't have, you can't deal, right? So if I ask you a simple question, why this is so required? Now you must be doing, some of you may do SIMA and all, right? SIMA exam or marketing or whatever. Then, or you are reading for MBA, right? So when you do this international related education program, you need to pay some subscription fees to overseas institution, right? So you might have a local agent here. So you will approach the local agent. You need to pay SIMA subscription. Then SIMA UK says you need to pay GBP 60 as the annual subscription, maybe 150 for the full subscription, exam fee, everything. You need to pay a certain amount of GBP, right? They are requested you to issue a bank draft. So now you go to any of the leading bank and you make a request. I want to send a bank draft GBP 200 favor of SIMA in UK. I want to attach this bank draft with my application. I want to register, post it, and send it to them, or courier it and send it to them. So you come to the bank and the bank is going to issue a draft, which is going to payable in UK. So you should know, okay, how come Bank of Ceylon, how come you can go to a bank and get a bank draft done, which is payable in UK, and the currency is GBP. So you should know, okay, if how is that possible? Because the Bank of Ceylon has some relationship with the bank in UK. Otherwise, they can't issue a bank draft which is payable in UK. They can't do that because they have this relationship. So you should know, okay, they have relationship, but remember, more than the relationship, when the payment is made, there is something else is coming. So we are going to learn that also. So here we are talking about relationship. You should have a relationship for you to communicate and exchange messages. For you to exchange messages, you should have a SWIFT arrangement. SWIFT, right? SWIFT. The SWIFT arrangement is called RMA. When you make a request through RMA. Once RMA is accepted, when both people can exchange messages, then their door is open. It's something like this, right? If you are a member in the Swift group, your ID will be your ID. That means your big code. You can send messages to other country, other bank. You have to go through the Swift. Everybody has access to Swift. You have to go through the Swift and make a request. Then the Swift will communicate to the recipient bank and say, a bank in Sri Lanka want to establish a RMA with you. Are you agreeable? Then you will tell the Swift, yes, we are agreeable, and they will accept. Then the Swift will send a message to the local bank, and they say, okay, you can both of you now directly deal with them. Now we are directly dealing with the other bank via Swift. Every communication going through the Swift. Now the door is open for us to send the messages. Earlier door is closed. We made a request to open the door for us to send the messages. That is something like that. That is what you call correspondent relationship. By establishing a RMA, you will get access to send the messages to the recipient bank via Swift. Then you can exchange messages uh, to do transaction, right? So the receiving bank may reject or may accept it. If they accept it, right, you are establishing RMA. Then you can exchange messages, right? That is how. Uh, so without no transactional message can be exchanged without RMA. Yeah, without RMA you can't exchange any messages. The RMA is the initial request, right? So you know now how this correspondent works. Right. Now you are going to learn two Latin words. And anybody knows what is this word? What is nostro? What is vostro? These are not English words. This origin of Latin. Latin nostro mean our. Our. Vostro, we, you, yours. So we are going to, so you can see nostro, vostro, account. So, okay, now we are going further step. Now you have a correspondent relationship. Now we are going to further step and we are going to establish an account relationship, right? So in other words, one of the bank in Sri Lanka going to open an account with a foreign bank, right? So that is a relationship we are going to learn here now. How do you call that relationship? Nostro and vostro. Nostro mean hover. Hover. Vostro mean yours. Right. Now, if I give you an example, so before that, you can read that an account held by one bank, another is referred to holding bank as an Nostro account. The same account referred to the Vostro by the counterparty bank. So what does it mean? I will give you an example. You will have better understand. Let's assume Bank of Ceylon maintain correspondent relationship with Australia with 10 banks, right? 10 banks. They're having Commonwealth Bank of Australia, ANZ Greenwich, National Bank of Australia, Westpac Bank. Likewise, they have 10 banks in Australia relationship. Now, Bank of Ceylon, when they deal with these banks, corresponding relationship, when they exchange messages, they have come to know Commonwealth Bank of Australia is a bigger bank. Their service is much better. Now, Bank of Ceylon want to open a AUD account with Commonwealth Bank of Australia. Now, Bank of Ceylon want to open an account with AUD currency in Commonwealth Bank of Australia because in Sri Lanka there are requests coming. We need to make the payment in Australian dollar. A lot of education payments are going to Australia. So you need to make a payment in Australian dollar. So you need to have an account relationship. Now Bank of Ceylon is making a request to Commonwealth because they are already having a correspondent relationship. They have the SWIFT. They have RMA. They can exchange messages. Now they are making a request. We want to establish an account relationship with you. Can you open an account on our behalf? Now, Commonwealth is also agreed. Okay, Bank of Ceylon, one of the bigger bank in Sri Lanka. Okay, we will accommodate their request. Okay, now they are going to open account. Okay, now once the account is open, now tell me whose account is that? Will the Bank of Ceylon call that particular account as ours, or will the Bank of Ceylon call that account as yours? What is the answer? Will the Bank of Ceylon maintaining account with Australian Bank, Commonwealth, AUD currency, how do the Bank of Ceylon will identify their account? It is their account. What is the Latin word then? What is the Latin word?
Nostro.
Nostro account. Yes, Nostro account. It is Nostro account. So Bank of Ceylon will say we have a AUD with Commonwealth. So they say it is our account. So Bank of Ceylon point of view, it is Nostro account. The same account in the perspective of Commonwealth Bank of Australia, they will identify Bank of Ceylon account in their books as V, Vostro. They will say it is your account with us. So you know, if a Nostro account is one person, the recipient bank will identify the same account as a Vostro, right? So Bank of Ceylon might have 10 relationship. Why they have selected only Commonwealth? Because of their services. So Bank of Ceylon, when they have a lot of Australian dollar operation, they might have other account with National Australia Bank. So they have two account. So remember, just because of your 10 banks relationship in Australia by Bank of Ceylon doesn't mean you have to open account. No, account opening is very costly, expensive affair. Very costly affair, very expensive affair. Why? You need to maintain a certain balance. Every transaction they will charge a fee. So it's very costly, right? Mind you, you need to pay in Australian dollar. So if you look at the exchange rate, it's appreciating, the rupee is depreciating, Australian dollar is going up 130, 20, now shot up to 145, 50 range now. So you see the rate is going up. It's very costly as far as maintaining more accounts. So depending on your volume of operation, you might confine to one or two accounts. Maybe Bank of Ceylon might have about 3-4 US dollar account. Maybe JP Morgan, they have one account. Maybe Deutsche Bank, they have one account. Maybe Citibank, New York, one account. Right? Why? These are currency which they have volume of transaction to be carried out. So they need to have more account in that particular currency. So every bank in Sri Lanka, definitely every bank in Sri Lanka will definitely have a dollar account with one of the New York bank. Bigger bank might have 4-5 accounts. So other smaller bank might have 2 accounts or 3 accounts. Right? Bigger bank might have 5-6 accounts. Bank of Ceylon might have 5 accounts, so 4 accounts or 5 accounts because their operations is large. Like HNB commercial, right? The operations are large, including People's Bank. They're large operations. Right. So their volume of operation is high. They need. So now you know what is Nostro, what is Vostro. If a bank maintain a local bank, Sri Lankan bank maintaining account with the other bank, the local bank will identify that account as a Nostro because this is their account. Now my question is, let's assume there is a bank in Pakistan, Muslim Commercial Bank. They are opening a LKR account with Bank of Ceylon. Right? Carefully listen. Muslim Commercial Bank opening a LKR with Bank of Ceylon, Colombo. Now tell me, Bank of Ceylon will identify that particular LKR account in their books as what account? Nostro or Vostro? NOV. You want to repeat the question? V, yes, Vostro. V, because it is the Muslim Commercial Bank's account is maintained with Bank of Ceylon. It is Bank of Ceylon point of view, Vostro account. But Muslim Commercial Bank will treat the LKR account with Bank of Ceylon as a Nostro. It is their account. Nostro, yes. They say it's our account with Bank of Ceylon. So Muslim Commercial Bank will say our, that is their Nostro. Bank of Ceylon will say it is your. So you know, in Sri Lanka, if you take all the banks separately, Bank of Ceylon, they might Bank of Ceylon might have 50 or 45-50 Nostro account. Same time, Bank of Ceylon might have Vostro account. Other banks are maintaining LKR account with Bank of Ceylon. So in Sri Lanka, if you take all the bank might have Nostro and Vostro, both accounts they have. In other words, while they are maintaining foreign currency account with other bank, they are also maintaining LKR account. Not only remember, it doesn't mean that only other banks, only they can maintain LKR account. No, they can maintain dollar account with us. Any currencies is possible, right? It's not only LKR. So there must be other banks in, say, Abib Bank Limited in Pakistan can have a dollar account in commercial bank. So again, same account. Abhi Bank, they will identify their account because they identify their Nostro. But commercial bank might identify the dollar account as Vostro. So it doesn't mean only LKR is maintained. No, you can maintain, a foreign bank can maintain dollar account also with us, right? Likewise, we are maintaining any currency with any other bank. The other bank also maintaining account with us. So that is the relationship. Now you know, for you to start a foreign transaction, you need to have a correspondent relationship. You have a SWIFT You have a SWIFT code. With that, you are making a request through RMA. Then the correspondent relationship established. Now you are going further step and opening an account. That is what you call Nostro Vostro accounts, right? So without these accounts, remember, you can't do any foreign exchange payment. So I told you foreign exchange transaction means converting rupee into foreign currency, or vice versa, foreign currency into rupees. So where without the bank account, how can you do this transaction? It's totally impossible. Right now, as I told you the same example, you have gone to Bank of Ceylon to obtain a bank draft to pay your SIMA. So Bank of Ceylon has issued a bank draft. The bank draft printed in Barclays. They issued the draft in sterling 200. Now my question is, what is the relationship with the Bank of Ceylon and Barclays? What is Bank of Ceylon is having relationship? What is the account relationship? Bank of Ceylon maintaining a what account with what with bank? Their GBP account with Barclays Bank. Yes. So what is that account? How the Bank of Ceylon will identify their GBP account with Barclays? Their GBP account with Barclays. How do they identify that account?
Nostro.
Nostro. Yes, Nostro. Barclays will identify the Bank of Ceylon GBP account in their books as V Vostro. Bank of Ceylon identify because Bank of Ceylon say it's our account. So remember, if you are account holder, you will call your account as our. Right? Simply think you are maintaining a savings account with your bank. You are account holder. That is your account. So you will identify your account with my account in commercial bank, my account. Instead of say my account, in internationally you call it as a Nostro. Your bank, your account with your bank, they will identify it's a Silva's account, it's a Pereira's account. So they identify their account, It's same way they will identify foreign bank's account as they mean your Vostro, Vostro. So now you know the word Nostro and Vostro. These are Latin word. Means Nostro ours, Vostro yours. Without these Nostro Vostro, you won't be able to do any transaction with international, right? Okay. So you know, you can, if you want, you can write down example for you to better understanding, right? If you want, you just say, for example, just say Bank of Ceylon maintaining Bank of Ceylon maintaining Bank of Ceylon maintaining a US dollar Bank of Ceylon maintaining a US dollar account with Bank of Ceylon maintaining a US dollar account with Citibank New York. A Bank of Ceylon maintaining a US dollar account with Citibank New York. Citibank New York is identified from Bank of Ceylon point of view, from Bank of Ceylon point of view, from Bank of Ceylon point of view, as a Nostro account, as a Nostro account. As a Nostro account, because it is their 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 account. Full stop. The same account, the same account Citibank will identify the same account will be identified by Citibank. You can write it in both. You see, the same account will be identified by Citibank. The same account will be identified by Citibank As vostro, we, as a vostro, as a vostro, as a vostro, as a vostro. Right now, you know the difference now, nostro and vostro. So now, tell me, can any bank make any payment without the nostro vostro? No, simply can't. For you to receive money, for you to make payment, you need to have a nostro or you need to have vostro. Without these two accounts, you can't make any payment international. So you know, in foreign exchange, the correspondent bank relationship, RMA relationship, with RMA only you will have a correspondent relationship. With relationship not sufficient, you can only exchange messages, right? But for you to do payment, you might have a further relationship called nostro vostro relationship. So the entire thing is considered as a fully fledged relationship, including account opening relation. Nostro vostro. With that only you can carry out all your foreign exchange transactions. So these are basics. This is what foreign exchange transaction, cross-border transaction. This is the relation, the basic fundamental requirement of corresponding. You make the correspondent relation with RMA request. Then you identify a bank gives a better service. Go and open account with them. You identify if it is your account. You identify your point of view as our account, Nostro account. The same account will be identified by the bank holding the account. They consider as your account. They will identify it as Vostro account. So Nostro and Vostros are the account facilitating payment among the banks. So these are assist you to make the payment. So you write the example, right? Now we are going to look at it current international transaction. So you know central bank has given direction. Central bank has given certain guidelines based on the act that have been enacted in the parliament, Foreign Exchange Act in 2017, replacing the earlier Exchange Control Act, which has been in existence for more than 6 decades, right? That was replaced by Foreign Exchange Act, which was came into force 20th of November 2017. 20th of November 2017, Foreign Exchange Act came into force. When the act came into force, that act, based on the act, the central bank will issue direction and guidelines. Those direction and guidelines will come into the authorized dealer, and the authorized dealer, based on the direction guideline, they will permitted to do certain transactions. That permitted transactions are considered as current international transactions. Remember, there are two type of transactions. Current, you may call it as a current transaction, or better to say current international transaction. The other one is capital transaction. There are central bank point of view, there are two transactions. One is current, one is capital. The current transaction definition, so any transaction without the involvement of movement of assets are considered as a capital. So without the movement of assets, is everything considered as a current transaction. So when I say you want to make education, you want to go for a trip, you want to go for work, right? So all that is comes at a current. You want to buy, import, you want to you want to do a medical treatment, whatever you consider any goods or services considered as current transaction. So the current transaction can be carried out as per the direction. All the banks can carry out the current transaction. But there are certain capital transaction you can carry out, but not all the capital transaction. So you know, central bank divided their all the transaction into two folders. One is the current, which is the majority of the transaction. There are other specialized transaction called capital transaction, which is definition is movement of assets. It can be financial asset, it can be real asset. So the movement of assets are changing between hands are considered as a capital. So those capital transactions are also permitted, but there are limited transactions only. Not every transaction is permitted. Therefore, still, though we have a foreign exchange act, doesn't mean you can freely anything you can do. No, there are certain guidelines. So, but if it is a current transaction, you can simply do. So you and me, everybody try to do a current transaction. We don't buy an apartment or we don't buy a property in other country, no. We don't go and invest in other country. So as far as a general person is concerned, the current transaction looked after their requirement more than enough, right? So these current transactions are payment connected to businesses buying and selling goods, all that is no assets. So the definition of current transaction as per the IMF, it says not for the purpose of transferring capital assets. So there is no assets involved. If it is not for the capital transaction, any transaction treated as a current. So the current transactions related to foreign trade, import export, uh, by taking loan and making payment considered as a current transaction. uh, you can make some investment. The investment is in capital nature, but for you to make that investment in the form of a loans, buying loans and all, it treated as uh, making investment in the form of a loans. The interest component is considered as a current. So it's we are talking about moderate amount of amortization. Amortization is maybe interest and the repayment. That is considered as a current transaction, permitted current transaction. Payment of moderate remittance of family living. Family, your cost of living. Say you send your children or you are going to study, your parents has to remit money. So those are family living expenses, right? So those are current transactions. So you know the definition of current transaction. Any transaction related to goods and services, basically current transaction, right? So relating to goods and services. So how do you do this transaction, whether it's current? You need to verify by going through the relevant documentary evidence, right? So whatever the document evidence submitted, you need to go through and verify whether the document evidence are sufficient for you to do the transaction. Then satisfaction of the server. So when you go through whether you are satisfied, remember, as per the Foreign Exchange Act, when you are not happy with the documents, you can decline, you can reject the transaction to the customer. Under the Foreign Exchange Act, there is a provision. So when you are declining a transaction, remember, if the customer says, okay, I want, when you are rejecting, give me a letter in writing that you are unable to do. So that act provide a provision that when the customer make a request, bank has to issue a communication, a form of a letter saying, as per the submitted documents, we are unable to verify the genuinity of the transaction. Therefore, we are not in a position to effect the transaction. You have to give a letter. So the Foreign Exchange Act, uh, as a provision, if a bank as authorized dealer, you are rejecting a transaction under current transactions by the document evidence not sufficient, you say simply document evidence not sufficient, we are unable to do. But if the customer can insist, no, verbally only you are telling, I want a letter. But the Foreign Exchange Act says, yes, the bank has to give a letter. Then he can take the letter within 7 days period to the central bank and get a their ruling done within 7 to 14 days maximum period is there. So he has a time period for him to reach central bank to get their okay done. If the central bank also has the same view of commercial bank, they might reject. Or if they ask more information from the customer's point of view, if the customer is produce that, and if the central bank also feel, okay, this transaction on exceptional basis can be considered, they might give a special approval. Remember, that's a special approval. That is not a general permission. There are two things, remember. General permission is every bank can do. So that every bank can do that. That is we call current transaction. These are general permission, because general permissions are given by way of direction. So when these directions are issued, all the banks can do this transaction. Of course, subject to exercise due diligence. Yeah, you need to be asked for the relevant document. You need to support and show the customer has to produce the document evidence to ensure this is the genuine transaction. Then no. So how do you know the genuine transaction? By going through the documents. If I take example, if somebody coming and say, I want to send some money to my son in Australia, education payment. She want to remit some money to the cost of living. So as a parent, she make the request to you, he or she. But as a banker, you know there is exercise to be done. So you will ask certain documents, right? Definitely you will ask where is the offer letter, where is the student visa, how much you have to remit, what is the document evidence from the university. These are the supporting documents you ask, right? Identity of the student, what is the number, all that you ask. So if she produce the document, you verify the documents, you are happy, then you send the remittances. That is what all about current transaction. So it has to be permitted. It has to be permitted. How do you verify the how do you know it's a permitted? You need to going through the documents and verify. You need to satisfy, then you release the foreign exchange. So either you can make the payment by way of draft or by way of outward telegraphic transfer. That means outward payment via swift. There are method to send the payment. So you follow one of the method to send the money. Then not only that, you have to report to central bank whenever there is a payment release. You consider that as a sale. Remember, there are two words you have to learn in foreign exchange: sale and purchases. What do you mean by sale? What do you mean by purchases? Why did I say when you are releasing money for education purposes? Why do I say sale of foreign exchange? Why do you say sale of foreign exchange? Because what does the particular bank did to to send the money? Because they sold the dollar to send the money out. Let's say a parent come and say, I want to send my 10,000 Australian dollar as a course fee to Australia, right? 10,000 Australian dollar, right? Now she has only rupee account. So what you are doing? You are selling. You are selling Australian dollar, taking rupee from her. So you are selling. So you apply the selling rate. Generally, your buying rate and selling rate, you have two rates, right? The bank selling rates are more than the buying rate. So take example, if you are selling Australian dollar at the rate of 151, your buying rate may be 148.50. So 148.50 is your buying rate, 151 is your selling rate. So why the difference? Because you buy at a lower, you sell it at a higher rate. The spread is your profit. So you need to make a profit because there's a cost to addition. You need to maintain foreign currency. There is a cost to you. So the cost need to be covered by keeping a margin in the rate. So the bank buying rate are lesser than the selling rate. So bank apply the selling rate when they really sell the foreign currency to somebody. So here, the example here, when for the education payment, if somebody comes, you are selling foreign exchange, the sale mean you are selling. So in other words, a sale is reported, banks sold foreign currency and taking rupee. That is called sale. So sale of a foreign exchange need to be reported to central bank. Through their, now I think the reportings are done through online, right? The moment you do the transaction, same day, end of the day, you are uploading some data. I think your all banks, co-banking systems are now geared enough to upload this information to central bank on the same day, or if not on the next day. You need to report it to the sale because they need to monitor the central bank need to monitor the entire country's outflow and inflow, because that is what they maintain. So every bank sending dollars, how much out of the country? Every bank receive how much foreign exchange into the country. That is inflow and outflow. Because then only they can make a macro decision. So at a micro level, you need to report. Central bank put everything and take a macro picture and see how much the country as a whole receive, how much the country as a whole remit the money outside. Outflow and inflow. What is the deficit? Whether there is any surplus. If there is a surplus, you have a foreign reserves building up. If you're having a minus, then you will have a deficit. That means you are sending more money than what you receive, right? So that is called reporting requirement for central bank. And not only that, you have to keep the documents for future references. Suppose say a transaction has went into bad or found fraudulent, they might ask you, and now what are the document evidence? Because they might come after 1 year or 2 years, right? So you need to have the document evidence for future reference. So supporting documents are kept, right? Okay, now we are going to look at the current transaction. There are a couple of transactions. These all are permitted transactions. Current, transaction, all are services, right? Other than import export, these all services. Import export, you can make the payment. If you are importing goods or exporting, that is goods. Here, services. So what are their services? Travel, education, medical treatment, annual membership. As I told you, SIMA, if you are a member, if you have a freight charges, that means air and sea freight, shipping charges, royalties and license fee, professional fee, other permitted fee. So let us see what is travel. So what is travel? How the travel transactions are considered. Yeah, travel can be holiday or businesses. You can go for holiday, you can go for businesses, right? You make travel, right? So when you go for travel, what are the requirements generally? When you go for travel, what are the requirements for you to take foreign exchange from the bank? First of all, tell me, when you go for travel, what is the mode of foreign exchange you prefer to carry? Is it a card? Is it a currency note? Or you want to send a TT before you go? What is the mode? Or bank draft? What is the correct mode? Everybody prefer to carry currencies, foreign currencies. Or you can even use your debit card. Because all your debit card and credit cards are carrying international brand, Master and Visa. So these cards are enabled. You can use it in overseas. So you need not to worry. You can take your debit card and spend. Right? Sometimes the rate applied may be better rate than what you buy dollar a year. Sometime, right? Some places when you buy it is still cheaper to use your debit card rather than carrying all the way foreign currency notes. So generally, travel purposes, banks are issuing foreign currency notes, right? So what are the requirements? You need to produce your passport, your name page there, and if the visa is there to be taken prior to your departure, you need to show the visa and the return air ticket. So can somebody tell me what do you mean by return air ticket? What do you mean by return air ticket? Can you understand what do you mean by return air ticket? Right or wrong? Just say what is return air ticket. So you say you are going to Japan. What is return air ticket? You are saying Colombo to Japan, Japan to Colombo. So you can see return air ticket mean the salient feature of the return air ticket mean the journey should start from a particular location. There the journey also end in the same location. That means Colombo to Tokyo, back to Tokyo to Colombo. The journey should start from Colombo. The journey also end also from Colombo. Then it's called return air ticket. You can't release foreign exchange for one-way ticket. Remember. One way you can issue only for education purposes or people who are working for, because they don't come back immediately. They do their studies and come back. They never know, so they only buy one-way ticket and go. Only when you go for travel purposes, only you are releasing foreign exchange. Education, when you go for one-way ticket, that doesn't come as a travel. That is education purpose. So travel is simply holiday and business. So when you go on holiday and business, remember there are certain criteria. So I will give you an example. There are two people coming to your banks. One is, let's say, one is a lawyer, professional lawyer, is going for a court case. One is the other businessman. There are two people coming, right? The lawyer going to UK. He is going to attend some case as well as a seminar. He is going to stay for 2 weeks there, right? And there's the other person who is going to, let's say, is going to Malaysia and for a business visit for, he says 1 week I'm going. Now, if these two requests are put to you, how do you evaluate how much you can release? Can the customer come and the doctor can come and ask you, okay, I'm going to UK for a seminar as well as there's a pending professional case. I'm attending it as a professional. I want to take about 8,000 sterling. You know there's a limitation of 5,000 only maximum you can take it. But you can take the travel card. The balance you can take a travel card, right? So the doctor is asking about 8,000 GBP, right? But currently you can't. Current regulation is you can't issue anything more than $5,000 currency notes, right? That is a rule. You can't issue. More than 5,000, you can't issue 5. So it's 5,000 only maximum currency notes. Balance you can give a travel card or whatever, but he's asking 8,000 GBP. Now, on the other hand, there is the person going to Malaysia for 1 week. He's asking, I want $10,000. He's also asking $10,000. He's asking 8,000, maybe $10,000, little lesser than 8,000 GBP. Now, which request you consider favorably? Which request you might consider at a lower rate? Which request? Can tell me? Can you tell me? Two requests. One is a doctor by profession. He's going to UK for a seminar plus his official professional work. 2 weeks to UK is asking 8,000 GBP. One person going to Malaysia is a business person is asking for $10,000. You can give 5,000 currency notes or 5,000 travel card. So when these two are requests put to you, this is where I told you due diligence, exercise due diligence. This is where the due diligence comes in. You look at both requests. Both can be accommodated because they are going with the return article. They have the visa to go. No problem. But as a bank, you must look at it. If the business person go frequently, you have to be very careful about his passport. How frequent he goes, whether he stay there for 1 week or for some time, they will tell 1 week and within 2 days they come back. So they show you they are going to stay for 1 week, but they generally come back within 1 or 2 days. You can go through the passport and see departure and arrival seat. You know by looking at the departure arrival seat how this particular person comes and goes out of the country. By short trip, you know you can identify. He's a business person because his passport is heavily used. So you have to be carefully exercise this business request. The doctor's request by profession is a doctor. You know the country is going to UK and he's attending to official matters, so you don't have any problem because he is not a frequent traveler. His passport only UK visa is only Embo. There's no other places he has visited recently. It's a genuine request. So I would say you go and give the maximum to the doctor. But Indian person, the person going to Malaysia might give about $2,000 to $3,000. 1 week going to Malaysia, 3,000 to 4,000 is sufficient. 10,000 can be declined. You can reduce it to 5,000 maximum. Nothing more than that because that is justifiable. That exercise is called bank has to use. Bank has to use. That is what we call due diligence. You can use your discretion. Remember, bank can use that. No, it is central bank said maximum 5,000. That doesn't mean everybody you can give 5,000. If a person going to India within 2 days and coming, doesn't mean that he can take 5,000. No, it is a maximum. Even if you feel is 1,000 is only you can give 1,000. Let the person and go and make a complaint. But your justification is 1,000 because he's going to India for 2 days. You don't give more than $1,000, more than enough. Why is going for business? Remember, business he can't take the thing that you got to understand. Business, there are other payment terms. This is only for travel. The business, they can't do this foreign exchange to do business transaction. But their business visit can be meet any client, making any expenditure. That's fine. But you can't utilize this money to purchase goods. That is become a violation. That is what you have to be careful. As a banker, when you are giving consider foreign exchange for a businessman, you need to be careful because they might use this money for a business purpose. Buying goods, that is not permitted, right? Even you can't use your credit card, debit card for a commercial transaction. It is total violation, right? When you debit card, credit card issue, that cannot be used for a commercial transaction. Electronic card cannot be used for a commercial transaction. Always you have to use for a personal expenditure. Even if you use it for 2,000 commercial transaction, it's violation. But when you use the card for a personal use of $5,000, still that is valid. Why? Because the $5,000 you use it for your personal expenses. 2,000 is commercial. So commercial cannot be the commercial purposes. You can't use it. So you need to draw a line between what is commercial, what is. By the way, how do you identify whether it's a commercial or a personal use? Can anybody? So I'm buying one laptop. I'm saying it's a personal use. There is somebody buying 20 laptops. So how do you differentiate? You differentiate, look at the commodity, look at the quantity. Always look at the quantity. If the quantity is more than 102 or 102, 3, 4 is personal use. You are buying 2 to camera, your brother's son coming, no issues. But if you buy 50 cameras, it's become commercial. Simply looking at the quantity, you know it's a commercial. So you should know differentiate with the commercial or personal looking at the quantity, right? And the commodity and the quantity easily you can derive whether it's a commercial or personal. Now you know what is travel. Yeah, travel you can release foreign exchange with a return air ticket. Journey has to start from Colombo, end also from Colombo. That is return air ticket. Uh, then you need to decide how much you can release in the currency notes. There's a limit imposed by central bank currently 5,000 only maximum or its equivalent. What do you mean by or its equivalent? What do you understand by that? What do you mean by its equivalent? Suppose say somebody comes and asking you 4,000 GBP. Now 4,000 GBP is asking. You know 1 GBP is more than 200, 240 or 50, right? GBP. So you need to work out and see $5,000 at the rate of 205 is how much rupee equivalent. And if you divide it by the GBP request, if this is exceeding, then the 8,000 and the 4,000 GBP is exceeding $5,000 equivalent. So the equivalent will come when you release any other currencies. It has to be equivalent rupee of whatever $5,000, whatever the applicable is, equivalent rupee divided by that particular currencies exchange. For example, if somebody coming and asking you uh, uh, GBP 4,000, so how do you work out $5,000? The rate is $210 rate. You get the rupee component. Divided the rupee component by the selling rate of GBP, which is 260 or 70. If you divide it, if it is comes only 3,400, that is the maximum you can give in GBP 3,000. That is 5,000 equivalent in GBP is 3,400. Or you apply the cross currency between dollar and sterling. You know how much sterling you can give. So it has to be lesser than not even $5,000. So $5,000 is the year marked or its equivalent. So it has to be any other currency equivalent to $5,000. So you need to apply the cross currency between dollar and sterling or dollar euro, depending on the request of the currency. You can work out that is equivalent, right? You need to endorse it in the passport. Whenever you release it, you are supposed to endorse it in the passport, because when that particular traveler has been questioned at the airport, he has to show that he has bought it from the bank. That is the supportive. Even when you go abroad, when they're at the airport, they're checking. He can prove that he has been taken this foreign exchange from a bank. It's endorsed, and not for that purpose. It is a regulatory purpose. Here we endorse it. We need to know how much currency have been taken out of the country, because we are practicing foreign exchange. So there is a requirement to endorse it in the passport, right? Endorsement need to be done in the travel. Okay, we are coming back to education purpose. This is slightly different. Now, on the top, I said separate file to be maintained. Can anybody tell me why do you want to separate file for education? Why do you want a separate file for education? Because you can maintain the normal box file. Why I put a separate file to be maintained? Can anybody tell me what is the reason? There must be some reason. Why? Because these are payment continuously you are going to effect it until the course is ending, right? Let's say the course is running up to 4 years. So the guardian or parent might approach you 2 to 3 times at least until the course is over, or semester by semester they are making payment. So you can't keep this document in a normal box file, because once the box file is full, it goes to the record room, because the education payment need to be made on the next year also. Because when the parents comes next year, you can't ask the parents, can we have some supporting document? The parent might say, why last time I effected you with your bank? You might have the documents. So you remember, when somebody comes for education purposes, you need to maintain a separate file with that particular documents. Initially what you collect, keep that and write the name of the student, probably his ID number in the university, and the name of the university in the on the top of the box file. Maintain that. You don't need to maintain so many files. Very limited people are sending money frequently, so you need to maintain few files. So that is uh, a best practices to accommodate, to maintain a separate file for education purpose. Those are best practices, right? So coming back to evaluating these requests, a student coming, an offer letter, uh, college entrance documents, passport copy along with the student visa, course fee to be remittable only to educational organization. What does it mean to you when somebody coming for education firm? So you ask for simple documents, whether there is a offer letter given by any university, any educational organization, whether this particular boy has been taken for this semester, this particular course. So there will be offer letter issued by university. It can be carrying signature or computer printout. Doesn't matter as far as it's a valid offer letter. Then there must be a student visa, because you can't remit money without the student visa, right? So you need to have a student visa when you want to remit money, right? Then it is said that course fee generally bank do not remit the course fee to the student name, simply because you never know, once a student goes there he will open an account, but when you remit it to his account you don't know whether he's paid the fee. So it's always best practices is to course fee has to go to the university, not to the student's account. Cost of living you can send it to the student's account, right? It is possible to send the cost of living to the student's account. uh, then also remember, when there is a when the offer letter says, let's say a particular person going to Australia for a degree program which is running up to, let's say, 4 years, right? So his cost is mentioned per annum, let's say per annum is 30,000 AUD per annum. So he need to pay 30,000 per annum. So the guardian or parents can tell you, okay, we want to make this 30,000 before he goes. He has to make the advance and he has to go. So either he has to they have to remit the money and student visa is there, but he's not immediately going. He's going later. So you check the offer letter, and if he already got the student visa also, does you collect that and his passport copy where his personal data. You collect these are basic documents and you put it into the file, and you remit money. So you are remitting money, entire course fee 30,000 to the particular university in Australia. So once you made the payment, remember, you need to make a note in the file. You need to make a note in the file. Somewhere recorded in the file, uh, date what you remitted, how much you remitted, right? Favoring whom for what purposes. So you are remitted particular date, 30,000 AUD, favoring the college. The purpose is to make the course fee. Likewise, when you make the payment for cost of living, you make the date and the amount favoring the student name. Purpose is cost of living. Likewise, you every time when you make a payment, it is getting recorded in the file so that you have a first-hand information. If the central bank want to check the file, you know all the records are there in the file. Even the file can be maintained for 2 to 3 years. So this is how the you maintain education file. Now, somewhere down the line, you would have seen cost of living could be considered semester or term basis. Why is that? Suppose say there is an offer letter. It stated 30,000 course fee, 12,000 cost of living for a whole year. 12,000 cost of living. Now, if the parents wants to remit the course fee 30,000 together with 12,000, two payment, one is goes to university, one is goes to his account. Is it really necessary the 12,000 to be remitted at one shot or not really necessary? No, it's not really necessary because you remit semester by semester. Because cost of living, you are going to send the money for future purpose. So, so remember, there should be reason why there is no point remitting the cost of living at once. But then you might ask the question: then how comes the 30,000 course fee why you are remitted full? Remember, remitting the course fee in full. Remember, sometime the student might get a discount. And once he made the 30,000 payment at one shot, there could be possible discount, 10% or 15%. So that amount will be credited to his account. So by remitting the course fee at one shot, you are getting benefit, indirectly some benefit to the student. So remitting the course fee in full is okay, fine, that is acceptable. But remitting the cost of living in a situation now, the current situation, even remitting the money for student, you need to wait. Even a course fee, you are unable to rate because we don't have banks, do not have dollars. Everybody waiting in the queue. Because that is the issue when you have a foreign short of foreign reserve. Now you would have practiced all the difficulties people are now facing, right? That's a classic example. When you don't have foreign reserve, what are the difficulties people will face, right? So these are real recession, real economic recession. That is really economically we are very going through a very tough time, right? So due to this prevailing situation, everybody is very bit scary how the things will looks future. Is everybody is concerned why we are in a very bad shape. So in a situation like that, remitting cost of living is totally out of question, right? Even course fees you are unable to remit mean cost of living you can take bare minimum, right? So that is because of the country current situation, right? So those are the things you need to look at it when it comes to education, right? So we'll say when the time permits, if you have question, we'll discuss the question, right? So education, you know now, then you know. I have given you a I have given you a example of an offer letter. You can see here budget category, tuition fee, they are put fee, rooms, meals, they are put, right? So you need not to put the room meals and all one shot. You can send the semester by semester, maybe 3 semester or 2 semester. You break into send the cost of living. But cost fee you can remit the full amount because you tend to get some discount. Uh, so these are the documents you need to take. Remember the important document. There should be a student visa. Without the student visa, you can't remit because that is a key document. Offer letter you can download it anywhere, but the student visa is the key where the child is officially authorized by the relevant embassy to go, or the country has given a visa him to go. That is a document you need to have. You can't remit any education payment without uh, the student visa. So there are instances you might have to pay advance before get the visa to enroll. Instances like that can be accommodated on exceptional basis. Even central bank has given the permission. Even some university might say before we offer letter, you have to send a $5,000 as a joining fee or whatever. If there is a request by a particular university, you can show the document evidence and you can remit the money. But subsequently, you have to show the once you if you want to remit the balance money, you have to show the visa. Student visa need to be shown, right? Is that clear? Okay. Let's see. Instead of notes, if you have some paper discussion, you can write down notes, right? Yeah, medical. The other important aspect is medical. Why medical is important? Medical also important because there are people who go for a foreign treatment. So when there is a foreign treatment, there should be doctor's prescription or hospital prescription. The overseas treatment is required, and if possible, you get estimated cost of the operation or treatment from an overseas hospital. Then the foreign exchange could be released. Then I have put the most appropriate mode of foreign exchange. What is the best way to take foreign exchange when you are going travel? Currency note is the best to take, right? Remember, the most appropriate is to currency note, and uh, you can't send bank drafts, you can't send TT. Those are not correct mode for here. The currency notes or the travel card or the debit card. So those are the correct mode to take money for medical purpose. So that there again, medical is permitted transaction because it is a service with why you are going for a special medical service to overseas because you don't have the services here. That is the reason you are going back to a country where you need to uh, get that service done, right? That is the reason the medical also permitted, right? Payment to other permitted services. What are other permitted? There are other services. Any other professional services, any services, you need to have a valid service agreement, right? An invoice should be there. submission of a tax clearance, because inland revenue got a new direction. Whenever the service payments are made, you need to you need to produce the you need to produce the tax clearance, uh, tax clearance from inland revenue. You need to produce it. So once a tax clearance is produced, considered as a document evidence for a service payment, effecting the payment, right? So what is a service? Now, generally, if you are working in a bank, some company all of a sudden come and say, we want to send some money to IT company in India, 50,000 US dollar. Now, see, you are getting an invoice from a IT solution company in India for 50,000 US dollar, just an invoice only. So they come and say, no, they have upgraded our system. We have upgraded. We have gone into the new version of some our main system. So this is the fee. So when that kind of invoice is given, because you are unable to verify by looking at the invoice, you need to know whether there is a service agreement entered by, because there's a large amount first of all, right? And there should be valid service agreement between the service provider and the local client who received the services, right? So you look at the agreement and see whether the agreement is as a provision to make this payment, and also the invoice, the company which is issuing the invoice, say this is the 50,000 or whatever the amount payable to them. Then you get a some declaration from the local company whether they got the services. Because service fee, when you are emitting, remember the service should have been given already, should have been enjoyed by the local client. So the local company or the local client has to give a confirmation to the bank or undertaking to the bank, this particular service has been given. Our computer system has upgraded. The upgrade version came via online access. So our entire system is now upgraded. Now we are geared to operate with a new system. So that is because everything online. So as a bank, when you are effecting payment, you don't know how this modality works. So only by documentary evidence. So he shows an agreement. That agreement has a provision to remit this money, and there's an invoice. But you don't know whether this service is really given, because you can't go and do this. The bankers' works are not there to go and check whether the company has upgraded. That is not our job. But you need to know. You get the supportive documents to ensure the service receiver confirm that particular system has been upgraded. So you have a documentary evidence. So take a declaration when you are not sure from the local client that particular service has been offered and their system have been upgraded. As per the agreement, this payment is due. So that you have a letter. So tell them to take a tax clearance from inland revenue. Inland revenue issue tax clearance for service per. So they have to bring the tax clearance. If these documents are in order, you can make the payment. So any other services, always remember these are the requirements. So if you happen to working in a foreign department or wherever, if you get a request of this nature, uh, what you think of is common sense. These are common sense. So before you make a payment, you should know why this 50,000 is going. Whether I have checked this, whether there is an official agreement between these two parties. You know your customer name is there in the agreement. You know the invoice is raised by ABC Company India. Their name is in the agreement. You know there is an official agreement between these two parties. Then by going through the invoice, you know the service. What is the description of the service? Who is the service provider? Who is the service receiver? You know the service provider is Indian company, service receiver is a local company, and the local company is your account holder, and you know verify that your account holder is into the IT field. You check that whether they have a system related work they are doing it. Yeah, they are into IT solution, so their system is upgraded, and you are getting a declaration from them that system is upgraded as per the service agreement. Now you verified everything and take the tax clearance from inland revenue. Now you make the money. Tax clearance means that they have paid taxes for this entire operation. Due taxes payable to government have been paid. So the tax clearance will say, okay, this payment is after taxes have been paid, and they give the clearance. Right? So there is a bit of argument going on for some services. Inland revenue says not required, but then bank says they request everything. So you need to be draw a line, because when there are services, there are one-off services. There is no tax clearance is required, right? So, but if it is a ongoing thing like a valid service agreement kind of a thing, you need to insist tax clearance, right? So remember, it's an ongoing thing. Continuously, you need to make the payment. There is a valid service agreement. Tax clearance is a must, right? When I say one-off case is not required, let's say you want to install a machine, right? You install a machine, then there is a professional fee that guy has sent the is cost is fee air freight and all. He has to ask you to remit about $450 for his air freight and all, or his fee to fix the machine. That is just one-off payment. For that, you need not to have a tax clearance. That 450 is just a service, one-off service payment. That doesn't attract the tax clearance. Tax clearance means it has to be a continuous service provided. There should be valid service agreement. Professional service are provided on a regular basis. That kind of a request coming, tax clearance is a must, right? Is that clear? Okay. Right. Now we are moving on to the bank guarantee. Totally different segment, right? So I'm trying to cover the bank guarantee also during this session so that you will have at least initial foreign exchange transaction. Then you will have a bank guarantee. Probably we move on to some foreign currency account if permitted in the next session, few session, right? Okay, so the bank guarantee is something is a very unique product, which is every bank prefer to use this bank guarantee because it is one of the product where you can earn more commission, more fee. It's a fee based product, right? It is a fee based product. You earn more fee. But on the other side, this bank guarantee as a salient feature will be considered as a contingent liability. So I will just explain bank guarantee. What is bank guarantee mean? When there is a transaction between two parties, there is an underlying transaction, right? When this underlying transaction to take place, a third party, generally as a financial institution like a bank, comes as a guarantor to facilitate the transaction between these two people. If not, the transaction wouldn't have taken place. Simply because the bank guarantee one party from the other party. So why the bank guarantee is really is used heavily in internet foreign exchange transaction because uh, the party who trusting somebody and remitting money, if the person who has taken the money to deliver something as promised, if he doesn't deliver, there is a financial loss to one party. He's suffering some losses. In order to avoid that kind of a situation, only the bank guarantees are used, right? So the bank guarantees are used to avoid a situation where one party is suffering from losses. It could be financial losses, it could be damage of the goods losses. End of the day, it's anyways a loss in finance, right? So you need to suffer. So when somebody is suffering, going to lose something, then he might cover that exposure. He might ask for a bank guarantee so that he is secured, he is covered under the transaction. For that only bank guarantees are used. So you can see bank guarantees a signed undertaking by a bank to party on behalf of a customer, assuring the beneficiary to effect payment on default of obligation. It is only come as a default of obligation. So remember, it is not an ordinary thing. If somebody has to break the promise, somebody has to default, then only the bank guarantee comes into force. So that is the reason bank guarantees are considered as a contingent liability. It is not a real liability. It is a contingent liability. Contingent means something future, some incident, some event can happen or cannot happen. But currently you don't know. That kind of a situations are called contingent. So this is guarantees like a contingent liability, right? So I will just give you example. There are type of guarantee: direct guarantee, indirect guarantee. I will explain so that you will have a. I will give you two examples. So direct guarantee, indirect guarantee, then you will get a clear picture, right? So I will explain direct guarantee, then I will explain indirect guarantee. Direct guarantee means a guarantee is given by a bank direct to the beneficiary. There are three parties. One bank comes as a guarantor, The person who is instructing party become an applicant, and the guarantee issued in favor of a particular party called beneficiary, right? Let's take example. Let's take example. I'll give you an example. They say there is Nestle, the milk dairy product. Nestle is an agent, right? Now, what they do, they import milk powder and they distribute to their local agent, right? Now, each local agent get their quantum of whatever the commodity uh, in large value, large quantity, without making a single payment. So they will be given 1 to 2 months to sell it to the retail, to sell these stuff through the retail shop and collect the money and pay them. So in this 2 months process, a credit period is given. Sometimes 3 months credit period, right? What happens now? Nestle, let's say Nestle has 10 distributor in a particular location. They might have island wide more than 1,000 distributors. I'm just for the hypothetical situation, example purpose. You just assume there is an area. They have 10 people there in Colombo district. There are 10 people are there. These 10 people covering the entire Colombo. Each person will be given 5 million worth of goods anytime. So each distributor will have 5 million goods. He will go to the Nestle company, collect the 5 million goods and keep it in the warehouse. The local distributor will definitely have a warehouse and fleet of vehicle for them to go and distribute to the retail shops. So one person cover the Colombo 1 to Colombo 3, one person covering. Maybe Colombo 4 to Colombo 7, one person is covering. Likewise, there are 10 distributors covering the entire Colombo. Now each distributor will have 5 million worth of goods. Now what is happening? When that particular distributor, he has a store place to store, he has a fleet of vehicle to distribute, but he doesn't have money to upfront pay and get them because he has to collect it. He also give it to the retail shop on a credit basis, 1 month credit period or 2 months. He has to collect it and repay. So the operation works in this way, credit period. So what happened when Nestle import commodity 100 or 150 million commodity and they are giving 10 million goods to everybody or 5 million goods to everybody, they're taking an exposure. They're taking a risk here. So how do they cover the risk? They will ask the local distributor, you better give a bank guarantee for me for 5 million rupees. I will give you 5 million worth of goods to you. So I need a guarantee for covering for 1 year period. Because it is turnover. Every 3 months you sell it and pay every 3 months. But under no circumstances, Nestle will give you more than 5 million. Once they give the 5 million, you have to pay back. And they give the other new stock for 5 million. Then again you have to pay back. Your guarantee is for 5 million. They keep the guarantee for 1 year and you will sell it and repay. The guarantee will be there as just a piece of paper. As far as this local distributor making the payment, buying the goods from Nestle, making the payment, the guarantee is just a piece of paper. That is what you call contingent liability. So the guarantee is kept as a security by Nestle in the event local distributor is try to default without making the payment as promised to Nestle. Now Nestle going to lose financially. So Nestle will claim it under the bank guarantee. So that guarantee is called direct bank guarantee. That means the guy, the local distributor, has to approach his bank, asking his bank to issue a guarantee favoring Nestle. So the bank going to issue a guarantee favoring Nestle, the bank is not going to issue because of these good client. Your bank want a security. So bank also taking security to issue a guarantee. Why should bank take exposure of some of these customers and taking on behalf of him exposure to Nestle? Why should they do? They also will cover by taking some security or collateral. Right now, this distributor has to pay 5 million security, and then bank will issue the guarantee, and he knows the guarantee goes to Nestle. He has to make the payment to Nestle. If he doesn't, if he want to default, his bank will debit his account and not going to make the payment. So he never going to default. Never going to default, right? Now see how Nestle covering themselves by taking a bank guarantee. That is the beautiful of bank guarantee. When you do transaction, wherever possible, if you are especially dealing with an unknown person and you are giving some work to him, you don't know whether he's going to perform up to your expectation or he's not going to deliver the stuff what you ordered, then you are exposed to a financial losses. In order to cover that, you simply take a bank guarantee. from a reputed organization. It has to be reputed bank, right? Okay, it's a bank issue, right? Now look at the direct guarantee, how it works. There is applicant, you think as a local distributor. There is a Nestle is the beneficiary. There is underlying transaction between them to supply good 5 million. That is the underlying transaction. Now remember, there is underlying transaction. Guarantee comes as a secondary. So you should know every time when the guarantee comes, there is an underlying separate transaction between them. The guarantee comes as a secondary. The underlying transaction to submit 5,000 worth of goods on a credit basis, he will pay. That is the underlying transaction. But for Nestle beneficiary to execute this 5 million, they want a bank guarantee. Then only they will undertake this transaction. So what is happening now? He gives his instruction. There's a contract, underlying contract. As per the contract, the applicant has to go to his bank because the beneficiary says, I want a bank guarantee. Then only I release you 5 million goods. He goes to his bank, issuing bank, asking his bank to issue a guarantee. He's giving instruction. And the issuing bank issue the guarantee favoring the beneficiary. So the issuing bank become a guarantor. The issuing bank become a guarantor. The Nestle become a beneficiary. The applicant become a local agent. So now you know, okay, this is how the guarantee works. So you can see, without the guarantee, Nestle wouldn't have given the stuff. Nestle is refused to give the stuff without the bank guarantee. Because of the bank guarantee, Nestle keep on supplying the goods to all the distributors because they are getting a bank guarantee done. The bank guarantee is not there. Nestle expose the exposure. They will every time they will have exposure 5 million towards every distributor. Right? See, it's a cost to them. If you add it up and see, it's a large amount. So they cover that exposure by taking a bank guarantee. So you can see the transaction is simply possible. The underlying transaction is simply possible by taking a bank guarantee. So you can see the bank guarantee comes as a secondary. The primary transaction is the underlying contract. That is the underlying transaction. Because of the primary guarantee, the underlying transaction is in a position to workable, come into force. Because the Nestle, the moment they get the guarantee, only they will sign a contract. Okay, take 5 million goods. You are supposed to return the money as agreed. If he doesn't return, so remember, this type of guarantees are generally called on-demand guarantee. You call on-demand guarantee. There can't be any condition. Nestle don't get any condition. So the beneficiary get the on-demand guarantee. So when the on-demand guarantees are given, simply what is happening? Nestle say there is a default. The local agent not making the payment. Out of 5 million is default, try to default 5 lakhs. Now Nestle try to claim it. So how do the Nestle claim? Nestle will simply write a letter to the bank quoting the guarantee reference and the letter guarantee reference and the amount, and they will say, in the above guarantee, we are claiming only 500,000 as defaulted by the so and so being applicant of this guarantee. Please credit this 500,000 now account. Now simple demand. There is no condition they have to fulfill. So always remember, these guarantees are on-demand guarantee. There can't be any condition attached to the guarantee because they are simply taking the guarantee and giving the goods. There can't be any condition fulfilled by the beneficiary. So guarantees are on-demand guarantee, simplified format. The beneficiary claim at any time within the validity period. Guarantee will have a validity period, generally 1 year, right? If it is an ongoing one, it will be extended, right? Okay. So let's say this guarantee is over by this December, but this 5 million worth of goods are going next year also. The Nestle will simply tell the applicant extend the guarantee for further 1 year. Then the issuing bank will issue extension to the same guarantee. The guarantee is extended for further period of 1 year till 31st of December 2022. So it will be extended. So until the operation is there, guarantee can extend, right? That is called direct guarantee. Okay, but there is something called indirect guarantee. So I am going to explain indirect guarantee, right? I will give you an example, then I will show you diagram, then you will have a clear picture. Let's assume there is a contract, the SLT, Sri Lanka Telecom, want to upgrade their telecom line. Sri Lanka Telecom want to upgrade their telecom line. This contract is is floated internationally because you don't have expertise to do that here. So you are floating that into overseas foreign contractor to do this uh, upgrading telecom line. It's 100 million worth of project. Take example, 100 million worth of project. Now, when the internationally, when they float this contract, you call tender, floating a tender. Tender mean when you want to get the service goods, when you want to buy service or goods in a large amount, you float a tender. Then you know everybody applying. Then you secretly you have the power to select to which party to buy, which party to sell. You can do that. That is what you call tender, right? Tender is very useful mechanism when you want to buy large amount of goods or services. You always call for a tender. Or when you want to construct a bigger building, you call for a tender. Always that's the best option because let's say you are studying a particular college. Your college want to upgrade their school building into 5 floors, just 5 floors, right? Or 3 floors or 5 floors, right? Maybe 3 floors, right? I don't know whether college will be permitted to schools. Maybe 3 floors, right? Maximum 3 floors, but vast area, bigger construction. Now the school management can't be calling every contractor to talk to this very time waste, right? What they do, they will float a local tender. They will put a paper advertisement saying we are the biggest school in Colombo looking for a contractor to build up this 3-story building. What is the square feet? And this construction should start in January 22. It should be end by 23. Within 2 years. This construction has to be completed. Whoever willing to apply, you can quote your price and apply and share with your previous whatever construction you have made. Share the details of the project that you already undertaken. This is a requirement. Now, when they likewise internationally SLT going and floating a tender, asking to upgrade the telecom line 100 million worth. Who is willing to do this project? Obviously they went international because you don't have local expertise for the local, so it's not possible. So what happened when the foreign banks are now foreign contractors are interested in to bid for this project 100 million, they also want to do bigger project. Now there is a company from Japan applying, there's a company from China applying, there's a company from German applying, there's a company from UK applying. Likewise there are 10 companies trying to apply, everybody applying, but there is a requirement in the tender. When the tenders are applied, there's a requirement, a bid bond, a tender bond to be submitted for 1% of the contract value. The contract is 100 million. The 1 million bank guarantee should be also supported with a tender document from a reputed bank in Sri Lanka. The tender bond has to be issued by a reputed bank in Sri Lanka. Now, mind you, there's a problem. The tender document has to be submitted to SLT with a local guarantee. The tender bond issued by a local bank in Sri Lanka. Right. Now, let's say a German person wanted to do this contract. He want to apply. When you go through the instruction, he knows there's everything he can fulfill except the guarantee part. The guarantee part is approaching his bank, German bank, and asking, I want to issue a guarantee, $1 million to favoring SLT. But this guarantee has to be issued by one of the local bank in Sri Lanka. Whether you have any correspondent. So the German bank will communicate their correspondent in Sri Lanka. Right now, you are now connecting everything, right? The correspondent relationship. Now the German bank is communicating to Bank of Ceylon, or the Bank of Ceylon want to issue this guarantee. Now Bank of Ceylon have been asked to issue guarantee by the German bank, and they are giving instruction, they are giving a format. If the Bank of Ceylon willing to do that, Bank of Ceylon will say, okay, we can issue the guarantee. Our commission rate is 2%. Bank of Ceylon going to charge you 2% commission on the guarantee value. Out of 1 million, 2% they are going to charge. Substantial fee, yeah, right. But nothing. Simply nothing. They don't do anything. Simply they are going to issue a guarantee. That's all. Right. Now, what is happening? The German guy approaches this bank. His bank, their banker going to give some assurance to Bank of Ceylon for the Bank of Ceylon to issue. So how do you call that? They are going to give a counter guarantee. The German bank going to give a counter guarantee to Bank of Ceylon. Based on the counter guarantee, Bank of Ceylon going to issue a guarantee to SLT. Now, with that knowledge, just check this, how it's working. Indirect guarantee. There is a contract, yes. Beneficiary is SLT. Applicant, let's say German contractor. There are so many contractors will apply. So, example, we'll just say German contractor. He is the one going to take this contract. That is the contract to upgrade the telecom line for 100 million. So before they sign the contract is still not signed. They know there is a contract going to take place. Right? Now what happened? As per the contract, there's a requirement he has to fulfill, issue a guarantee. He goes to his bank, instructing bank, I want to issue a guarantee, which is a German bank. I want to issue a guarantee, a bank in Sri Lanka. Can you do that? So their bank will say, let us check and come back. So they check with Bank of Ceylon. He's giving instruction, I want to issue a guarantee. Now that bank is communicating through the SWIFT to a local bank, which is, let's say, Bank of Ceylon. Whether Bank of Ceylon to issue. So Bank of Ceylon said, okay. Now they are going to issue a counter guarantee. German bank issuing a counter guarantee with our full responsibility. You issue the guarantee. If there anything, we will pay. Based on that, Bank of Ceylon issuing a guarantee. Now see, in this example, you don't call it as a direct guarantee because there are two banks involved. The guarantee is issued by a local bank, not by the foreign bank, because the beneficiary is SLT, the applicant is the German contractor who is going to upgrade the telecom line, and the issuing bank is East Bank. East Bank gives the instruction to the Bank of Ceylon because they are giving a counter guarantee. No worry, we will pay you if there is a claim. Based on that, Bank of Ceylon issue the guarantee. Now the transaction is completed, right? Now my question to you is, beneficiary is SLT. Why did they request the applicant the guarantee need to be issued by local bank in Sri Lanka? Why did they? Why did SLT happy with the local bank? The local bank is Bank of Ceylon, but the German bank is much bigger than the Bank of Ceylon, much bigger bank. Why they have not taken the guarantee directly from German bank? Instead, why did they ask one of the local bank to issue the guarantee? Can anybody answer to that question? The SLT, why did they ask the applicant or the contractor who is interested in doing this project to issue a bank guarantee, requesting his bank to issue a counter guarantee, because the requirement is the guarantee need to be issued by the employer, that is SLT, employer's country bank, that is Bank of Ceylon, or one of the banks in Sri Lanka. Why is that? Because remember, SLT is an organization. They don't have any SWIFT arrangement to communicate to the bank. They are unable to communicate directly to them. They have their banker. So they always insist any transaction, their banker. Because if there is a claim, they will simply go and claim it from Bank of Ceylon. That's all they can do. Because they are unable to communicate to the German bank. So they know if the SLT knows if the guarantee given by German bank is a bigger problem for them. They are unable to communicate. They don't know how to claim it. But here, if the local bank issue the guarantee, it's very much easy SLT to lodge their claim with the local bank. So simply they go and lodge the claim, right? Then what happened? Bank of Ceylon will claim it from German bank. German bank will debit the card because applicant, when they issue the guarantee, remember the bank and the instructing bank, like the direct guarantee, as I told you, the local agent goes to his bank and asking the bank to issue the guarantee. When they ask, always the bank will not issue the guarantee until the person keeps some security. The applicant would have keep some security. So they recover the security and pay back to the Bank of Ceylon. That is how the structure works, right? Now this is possible. I told you bid guarantee. There is a bid, initially bid. So the bid guarantee generally comes from one person. So that means when the tender is called, they issue the bid guarantee. So now you can see there are type of guarantee. Most frequently used guarantees international trade. Bid bond, yes, that is you call tender guarantee. Then you have performance guarantee. You have advance payment guarantee. You have retention guarantee. I have also included shipping guarantee. First four are related same. Shipping guarantee is totally different. Now bid guarantee is also called tender guarantee. When you are floating a tender, you have to issue a guarantee, which is generally a written guarantee, third party, usually a bank submitted. Issue acceptance of the bid, because once the contract is accepted by the person who has to sign the contract, is contracting, is bidding for with the bid bond. So once a bid bond is generally 1 to 5%. You can see the percentage is 1 to 5% of the contract value. So if the contract value is 100 million, 1% is 1 million. Generally, bid will be lower percentage because every time when the bidder bidding, there is a cost. When there's a 5%, it is 5 million. So it's very costly because the commissions are based on the guarantee value. The higher the guarantee value, lesser the tender will be applied, lesser foreign contractor will apply because it's very additional expenses. Now see, there are 10 people apply for the same tender as I told you. Finally, only one person got it. All other 9 people lost their money because they pay commission, but they didn't get the contract. See, see what is that is what I said. Bank guarantees are very good. Now see what happened. Same example. If I go back to you this example, in this example, now see this applicant has approaches one example. I told you German. Likewise, there will be 10 people apply. Japanese person has approached People's Bank issue the guarantee. So bank of SLT got 10 bank guarantees from 10 different suppliers. All banks got the commission. But finally, SLT going to select only one person, which is they selected the German company is the best. All others, their technical committee shortlist these 9 suppliers into 5. Then finally, they take a decision to select German company because of their quality. Now only Germany is going to do the project, right? So all other 9 bank guarantee become null and void. There is no enforceable. The guarantee become cancelled, but the applicant has to pay commission. Even Bank of Barcelona people will issue the guarantee, they also claim their 2% commission. The commission has to be initial cost. So the bid guarantee, you can't be having higher commission fee, then lesser people will apply. So you need to bring the guarantee value requirement lower value bid. But once the bid is awarded, let's say the German guy is now has to sign because he bid it, SLT accepted it. Now the particular contractor, German contractor has to sign the contract. At the time of signing the contract, now SLT says, okay, now the bid bond is no more. You sign the contract. Now you replace the bid bond by performance bond. So that is the reason you could see now the second one is performance. And there could be advance payment guarantee. When there are payment to be made by SLT to the contractor to do the contract, there will be advance payment guarantee. SLT, whenever they make the payment, they want the guarantee before they make the advance payment. So once a contract is signed, they will ask the performance guarantee generally for higher value, not like 1 to 5%. So if you go through that performance guarantee, now you can see 5 to 10%, sometimes 15%. Why the employer SLT asking more percentage? Because it's going to cover the entire project value. Performance, like bid bond is for a shorter tenure, maybe 6 months. Bid process is over, but performance is a bigger lengthy period, larger value to be covered, right? So they are asking about at least 10% of the work. They hold the money as a performance guarantee. So they want a guarantee to be given at least 10%, because what happened when the performance is getting delayed, let's say the contract is given to German company started the work, but there are certain work they're delaying. Now with the 10% guarantee value, they can enforce. They will tell, SLT will tell, look here, if you don't complete the project by next year, at least 50% of the work will be completed by this year, and the next year it has to be fully completed. If the project is dragging, they can enforce the guarantee. So when they try to enforce it, then immediately the project, the contractor in Germany will start doing the project faster. Because with the performance, you can you can ask the counterparty to do the job perfectly. Because he knows he has issued a guarantee by keeping his collateral. If he doesn't perform, there could be bank guarantee. It's an on-demand guarantee. SLT will claim it at any time. So the contractor knows, as assured, he has to deliver the contract, deliver the work as agreed, and there can't be any shortfall, right? Now, likewise, performance guarantee, advance also same way. You can see see the last line, performance guarantee replace the bid bond. Yes, once a contract is awarded, bid is no more. Is the performance taking over. Parallelly with the performance, there is an advance payment guarantee also issued.
There again, whenever the SLT makes the payment, they keep a 10 to 15% as a guarantee, just to save, just to ensure the money is not used for any other purpose. There again, the generally advance payment also 5 to 10%. Right. There's something called retention guarantee. What is this? Can anybody tell me what is this retention guarantee? Why retention? Now see, this upgrading telecom line running up to 3 to 4 year project. Let's say 3 year project. 3 years the project is done. Right? Retention guarantee means SLT will says, okay, you give the retention guarantee of 5%, I will give you the money, entire money. The balance only 5 million to be paid. 95 million is over. Only 5 million to be made as the last part of the contract. Now they are not releasing the money, they want the retention guarantee. Why? The SLT want to ensure once the project is over, when they implement the project has to be performed as per the expected level. Now say all the lines are upgraded. When the consumers are using the line, the members are using the line, they realize there are default, there are shortcomings. Now, if the contract money is entire 100 million is paid to the contractor, contractor would have said gone. He's out of the contract. He would have gone. But SLT didn't allow them to go. SLT got 5 million guarantee and released the money. They pay 95 million, right? Balance 5 million, they asked the retention bond. They gave the retention bond and then SLT made the payment, final payment. Now they have the retention bond for 5 million. They can claim it at any time when there's a default. So the contractor now knows, I want to fulfill. If I don't fulfill, there could be claim come. He will ensure, he will come and repair the deficiency. There are defect. There are repairs to be done. There are certain areas they have not done a good job. So they have to come and do the repairs. So they have to do out of their cost. So now you can see, from the initial offering a contract until the delivery of the contract, how best the employee is protected by a bank guarantee. So you can see the Chinese are putting up most of the project in Sri Lanka. You can see highways, hotel projects, apartments, all over places. You can see housing complex are coming there. All that is supported by bank guarantee. All the employees in Sri Lanka taken the bank guarantee. If the bank guarantees are not taken, they will do they don't deliver a proper job. Instead, they will do some slipshod job, like they will have some defect. Uh, they will do whatever they want, because there are certain specifications the contract has specified. So the moment they are not delivered, the employer can claim it under the performance guarantee. Not only that, if the project is over, still by taking a retention guarantee, any defect also they can claim it under the retention guarantee if the contractor failed to repair the whatever the defect work. The defect work has to be repaired by the contractor. So that is what the retention bond is used. Any question you want to ask before move on to the shipping guarantee? Any question you want to ask? Okay. So shipping guarantees generally use, this is a totally different operation. When you are importing, when you are importing into, say, Sri Lanka, say, as importers importing some commodity, let's say the vessel has arrived, but the goods have arrived but the supportive documents have not come through the banking channel so far. Then what happened? The shipping company will not release without the original, you call bill of lading, shipping document called bill of lading. Without the original bill of lading, they don't release any documents to the importer to clear the goods. The title of the goods is the bill of lading. The title documents with other documents, it has not reached the bank, but the vessel has arrived. What happened when the vessel arrived? Generally, the ports authority will give certain number of days to clear the goods, because those unloaded containers are kept on the board. On the board, there is a separate space to keep the goods. you have to clear it within 1 week time. They give a maximum 1 week time for you to clear it. If you don't clear it, what happens? These goods will be moved to other location. Then the moving charges, protecting those goods, there is a charge. You call demurrage. Those charges are called demurrage. So you can see the second line, demurrage. The demurrage is extra charges you have to pay to the ports authority to look after the goods. So what happened? Shipping guarantees are generally issued when the importer a goods, where the goods have already arrived, but the supportive documents or the title to the goods document has not received by the bank. Then they have to somehow or other clear the goods from the shipping company. Then the importer will go to the shipping company, ask the shipping company, can I have a letter of indemnity? I will give you a letter of indemnity. Will you issue the shipping guarantee? Will you issue the delivery order? So what happened when the importer wants to clear it? He will go to his bank because he has already opened some documents. The bank open LC to clear that, right? So when you open the LC, to import. So remember, LCs are open for import purposes. When you want to import, you open LC. But here LC is open, but goods have arrived, but not the documents. So he will go to his bank and say, I open the LC, the goods have arrived, but the documents have not come to the bank. I want to issue a shipping guarantee. So what will happen when the bank will check the document, whether the invoice is as per the LC terms, when they check the document, and they will, what they do, they countersign the indemnity. They countersign the indemnity that should be given to the shipping company, the importer sign, and the bank countersign. The countersigning of the letter of indemnity is called shipping guarantee. So with the bank assurance, only the shipping company, in the absence of the original documents, they will issue the delivery notice. So the importer go and clear the goods without the submission of the original bill of lading. So what happened? He goes and clear it with the shipping guarantee. Now what happened when the original documents come to the bank? The importer go back to the bank and get the original bill. The documents have arrived to the bank. He collect the original BL, goes back to the shipping company, give the original BL, and get the guarantee cancelled. This is the interim period you do this until the original documents arrive, right? So shipping guarantees are issued generally by the bank countersigning the letter of indemnity in favor of the shipping company on behalf of the importer to release the delivery order in the absence of original bill of lading. Right? When the bill of lading comes, it is importer's obligation to go and cancel the shipping guarantee by producing the original bill of lading. Okay? Is that clear? Is that clear for you?
Can you explain again, sir?
A shipping guarantee?
Yes.
Yes. Shipping guarantee, I will explain to you again. It's like this. Let's say you are importing, you open LC with the bank, you want to import something. Let's say you are importing some food item from India. Take example, you open LC and the food item from India. Now, India vessel has come to Colombo within 48 hours. But Indian banks take long time to send the title document because the documents also has to come through the bank, right? Now, when you open LC, the documents from the supplier, from their banker, should come to your bank where you open the LC to get down the consignment. So you have gone and opened LC with Bank of Ceylon to import the foodstuff for under $1,000. The foodstuff the vessel has arrived, but the title documents has come from your supplier's bank to your bank, which is Bank of Ceylon. So when you go and ask the Bank of Ceylon says, yeah, the LC open, but still the supplier has not sent the documents. The documents takes time. Documents will be courier. But this process taking about 4-5 days delay. But here what happened? The goods already arrived. Let's say you opened the LC last month. The goods have arrived on the 1st of December. So you have up to 6th of December to clear the goods. Until 6th of December, the documents have not arrived. So you can't wait anymore because you have to pay damages. Before the last day, you have to go and clear it, right? The 6 days, the last day, Ports Authority says, otherwise they will remove the goods and putting it to the other side. Then you can clear it by paying damages, right? Because the original documents have not come. So what you will do, you know there's a problem. As an importer, you have a problem. So you will go to the shipping, you know which vessel the shipping coming, right? The supplier would have informed you. Supply, the moment he put the goods, he has sent you the copy of the bill of lading, copy of the invoice. By WhatsApp to you or he send you the images. You know the shipping company who is the agent. You go to the shipping company and say, I want to clear these goods. The shipping company says, okay, without the BL we can't, but we want a letter of indemnity signed by the bank. So letter of indemnity is a document to safeguard the shipping company that need to be signed by their bank, right? So the importer take the document and he has to sign in the shipping in the indemnity. He has to sign and he will give it to the bank. So bank will check what is the invoice value, whether they open the LC with the same commodity, everything they check, they satisfy. They will sign the indemnity countersign. And this letter, once the indemnity is countersigned, it is a comfort letter given to the shipping company to release the goods without the original documents. The original title documents is called bill of lading. The shipping company generally release the generally release the delivery order when the importer present the bill of lading. Now, importer is unable to present the bill of lading because the original documents are getting delayed due to the courier, right? But the vessel will be giving only 5 days for you to clear the goods. Otherwise, you have to pay damages. So all your profit margin will go for a 6 if you pay the damage. So you want to somehow other clear it. So you ask the shipping company says, okay, one option is to you give us a letter of indemnity countersigned by the bank, your bank. So he goes to the bank, get the indemnity countersigned, and he giving it to the shipping company. Shipping company give the delivery notice based on the indemnity. The importer will take the delivery and go to the ports authority, clear the goods without the original bill of lading. After clearance, after 7 or 8 days, now the original documents have reached Bank of Ceylon. Now, Bank of Ceylon will ask the importer, come here. We are given a guarantee on behalf of you. Here the original bill of lading. Take it and go to the shipping company. Cancel it and bring back our guarantee. So the importer will go to the shipping company, submit the original bill of lading, cancel the shipping guarantee, and giving it to the bank. Now, what happened? By using a shipping guarantee, he is avoiding to pay the extra charges in the absence of original document. This is only happened when the vessels has come before the documents arrive. Generally, documents come faster before the vessel arrive. Because what happened when you are importing from India, very shorter distance. Within 2 days, the vessel arrive. But the documents take 5 days, 6 days. But if you are importing from Europe country, generally documents arrive, you have to wait for the vessel to come. The shipping guarantee only comes for where the vessel journey is very shorter, like India, Pakistan, Bangladesh, where you are importing these things. When you are importing something Europe, definitely shipping guarantee is not at all required. Right? Is that clear for you now?
Yes, sir. Thank you.
Okay. That is shipping guarantee, right? Okay. Okay. Now, let's see whether you can answer this question. What is the answer? ABC maintain a dollar account with KBC Bank. ABC maintain a dollar account with KBC Bank. It is a Vostro account for ABC Bank. It is a Nostro account for KBC Bank. It is a Nostro account for ABC Bank. What is the answer? I put the answer also. Is it the first one correct? ABC Bank maintain a US dollar account with KBC Bank. ABC Bank point of view, what is that? It should be?
Our
ABC Bank?
ABC Bank.
ABC Bank maintain a dollar account with KBC Bank. For ABC will say our. Yes, your answer is correct. Our mean what account?
Nostro.
Nostro. Correct. You said our. It is Nostro account. That means what is the answer? Third one. 3. Yes, this is the answer. Right? Remember very carefully. So, right. In banking operation, what is meant by due diligence? When carrying out a transaction, what is the due diligence? It is the process of collecting all relevant documents. It is the exercise of verifying supporting documents to have better clarity on the requested transaction and making the final decision. What is the answer for this? It is the process of collecting relevant documents, the exercise verifying the supported document to have better clarity on the requested transaction and making the final decision, or all above? What is the answer? 1 or 2 or 3 or 4? Due diligence means you have to collect the relevant documents. Yes. You have to exercise, verify, and supportive documents. Yes. You have to better clarity to make a final decision. Answer is all above, right? So everything is called due diligence. You need to be 100% sure whether transaction is genuine. So you have to do all the exercise, not only collecting document. You have to verify. Then you have to satisfy yourself. Then only you take a final decision. So all above, right? So here there has been an offer letter issued by Kingston University, UK. A student indicating full UK University UK to a student indicating the full course fee per annum is GBP 20,000 and cost of living GBP 10,000 per annum. Course fee per annum is 20. Cost of living, and the course fee in full remittable at once. Answer yes or no. Can the course fee is full remittable at once? Course fee is 20,000. Can the course fee full remittable at once?
Yes.
Yes, 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 no problem. Because anyway, course fee can be remittable at full because there is a possible indirectly some benefit to the country. So always yes. Can the cost of living payable at once?
Can't.
Can't. Generally no, because cost of living could be remittable semester by semester or a term by term. It is really not necessary. So your answer should be no. It should be semester by semester. Okay. Then can the cost of living and the course fee payable? Can the cost of living and the course fee are payable to the student overseas? Can you make the payment of cost of living and the course fee to the student account?
Course we can't.
For cost of living only you can do, course fee can't. So the answer is no, you can't. You can't. Course fee has to be remitted to the university only or the education organization. So answer is no. You can specify and say no. Course fee has to be remitted to the college, right? If the cost of living is not mentioned in the offer letter, if the cost of living is not mentioned in the offer letter, can the bank remit the funds for the cost of living? If so, how the amount will be determined? You understand the question? If the cost of living is not mentioned in the offer letter, say they only mentioned 20,000 GBP per annum, the 10,000 cost of living is not mentioned. They're asking, in the absence of that, can you remit cost of living? If so, how do you determine? So yeah, sometime offer letter do not have cost of living. What is the reason? Can anybody tell me why the cost of living is not mentioned in the offer letter? Anybody can tell me what is the reason? Sometime at the time of you apply the education, you would have said, I am not staying in the hostel. I am not staying in the college premises. So when they issue offer letter, cost of living is not required. Cost of living is not need not to be mentioned in the offer letter, right? But in Sri Lankan context, it is required. Therefore, the bank will ask. So if it is not there, the bank can also understand he is studying. So though it is not mentioned, practically the bank cannot refuse because bank knows he is studying. So the bank can remit the money. Even though it is not there, bank can remit the money. But generally, it is semester by semester. So the bank will remit about $4,000 to $5,000. So how they determine the amount? Based on the country and the cost of living they know, but they remit amount to be usable for each semester they will remit. So answer is yes, they can remit the money. It is decided based on the semester by semester. Can the student is permitted to borrow from a bank overseas for his education purposes? Can the student is permitted to borrow? Yes, yes, borrowing is possible. Borrowing is possible, right? Student can borrow. Central bank permitting. Borrowing is possible. For borrowing purposes, whatever is partly working, he can pay. If not, parents can remit money because he has to use for education purpose. The document need to be verified. The loan is taken for the education purpose, right? It's not to buy the vehicle and parents pay. No, not for that. It has to be for education purpose. Right. I think that ends the presentation. Any question? So shall we meet in the next session then? They will keep you informed in the next session then. Okay then. See you then in the next session.